So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Anthony Scandariato. Anthony is the co-founder of Red Knight Properties. Red Knight Properties is a privately held boutique multifamily and mixed-use real estate investment and property management company with a track record of building and managing portfolios that deliver dependable cash flow and equity upside. Red Knight currently has over 750 multifamily units and 100 million in assets under management. Has gone full cycle on multiple deals since 2015. Anthony, welcome to the show.
Thank you, Jonathan, for having me.
Absolutely. Very excited to chat today. You guys have a solid portfolio. I was scrolling through it there. But before we jump into that, as we do with all of our guests, kind of take us back to the beginning. Were you doing anything before this, and what kind of led you to where you're at now?
Yeah, absolutely. So I was actually, believe it or not, in the consumer products and retail business before even getting into real estate for a few years, and got into real estate like early 2014, give or take. Ended up working for another owner-operator who was acquiring and managing multi-tenant Class A office up and down the East Coast. So when I started there, I was basically an analyst and helped underwrite deals, and was there about six and a half years. And, during my time there, I saw how they built a real estate company and did it in a way that was relatively lean in terms of their infrastructure. And they were able to do $50-100 million deals in a single transaction. And it wasn't a huge company. And I just found that fascinating. So I got to learn a lot. It was very invaluable experience for me. And on the side, I started building a multifamily portfolio slowly. Started out with 2 units, basically all value add type of smaller multifamily. 2 units I bought on my own, and then I bought a 2-unit with a partner that I flipped, and then ended up meeting my current business partner, Brian Leonard, through a coworker of mine, who, my partner Brian played for the NFL for 8 years, and he was at that time in 2016 retiring, and was in his early 30s and still wanted to work, so wanted to put his money to work and be active. So I met him, and we figured, why don't we, I told him I was buying 2 units on the side, and for the next deal, we were partnering up to buy a larger 10-unit property, and then we bought over about a year time period 70 units together, and they were all value add mixed use, so ground floor retail, apartments above, in suburban infill areas, within an hour outside of a major metropolitan area. And in our case, that's New York City. So ended up building a small portfolio for us, and turned a couple of the buildings we bought around in terms of the NOI growth. So we were able to do a few cash out refis and a couple sales. And so we felt comfortable enough to have a few case studies under our belt. And that's when we came across a larger 51 unit in 2019 that we ended up syndicating. So we brought other investors into our deal, and we were obviously going to manage it and operate it for them, and kind of just grown from there. So, pretty slow and steady, made sure that we, executed on our own deals before bringing on other people's money. So that's kind of how we were. And as of right now, as you mentioned, Jonathan, we have about 750 units, almost going to be 900, almost 1,000 in the next couple of months. And just been really excited. We've sold properties, we've refinanced properties, we've bought a lot. Obviously, the market has benefited us, but we buy regardless of market conditions. The higher interest rates we're seeing right now doesn't scare us, because that's I was in the market before that, although I wasn't really in a down market, talking 2006, 2008. But learned a lot from the principals that I worked for in that market, and how to underwrite and how to plan for, potential recessions and mitigate risks. So just trying to apply those principles in our own company moving forward. And the one thing I forgot to mention, Jonathan, is we have a in-house property management as well. So we have not only the investment side, but we have the property management side.
Awesome. Wow. I love that. That's a great story. And, really speaks to kind of getting that experience, right? You guys mentioned you did your own thing first, make sure you had your strategy and execution and all those things in place before you went out and got other people's money, which I'm sure investors appreciate, of course, and typically aren't going to just throw money at someone who doesn't have that track record anyway. So that was great. You guys were able to do that. I am curious. So why, what caught your eye about multifamily as opposed to, you're kind of in the office space, you learned that underwriting and worked for them for, like you mentioned, 6.5 years. But what caught your eye about multifamily and why you wanted that for your own portfolio and eventually for Red Knight?
Yeah, I was always interested in it. And, office, it's, an asset class that obviously has had its challenges during, the pandemic, and even coming out of it, still having challenges with people coming back to the office. So there's a lot of challenges. And for me, it wasn't so much the challenges, it was more of personal interest at the end of the day. I just found multifamily more interesting, and everybody needs a place to live at the end of the day. And the type of segment we focus on is more of the workforce housing. So my average rent across my portfolio is probably $1,000 for a 2-bedroom. And, we're serving, not the low end, but, above the, we're serving working class individuals that it's a demographic that I like. We call it workforce housing. We're taking Class C product that we're acquiring, maybe 1 to 2 story walk-up garden style, and we're redoing the exteriors, redoing interiors that haven't been touched for sometimes 30 years, and some of our deals. And yes, we are raising rents as well, but the tenants appreciate what we're doing, and we're kind of changing communities around. So it's kind of more of a personal interest, more of a mission driven as well. So those are really the 2 reasons why pivoted from office.
Makes perfect sense. And workforce is certainly an underserved sector right now. I was reading, I think just yesterday, about how developers are struggling to keep up with demand for Class A. It's like, yes, certainly there is demand for that, and it's necessary, right? Obviously, but the workforce housing and all of that is certainly kind of falling by the wayside a little bit, being underserved. So I like that. That's awesome. And certainly, the asset size as well is a little bit, probably a little bit less competition. So you mentioned that you're about an hour outside of New York. Are you on the New Jersey side for your market? Yes. Or are you, okay. Is there rent control there as well?
No, the areas where we invested in New Jersey, we own in soon to be 5 states. So we own New Jersey, New York State. We actually sold out of it, but still own there. Pennsylvania, Florida, and soon to be Ohio. So 5 different states. Those are all states that I covered when I worked at my old company as well. So got used to the markets and had some experience. So in terms of the rent control question, no, where we invested in New Jersey are, I would say Western New Jersey, which is a little bit more rural somewhat. So not very high density, not a lot of high density units, not a lot of apartment complexes. So the need for that, or even the desire to want to implement that, is not on the radar.
Awesome. I love that. And gorgeous part of the state, that area too. A lot of people don't know, but New Jersey is actually very gorgeous, depending on where you're at. It gets a bad rap. Certainly there are areas, but like any state, it has its areas you shouldn't go to. But man, getting into the countryside of New Jersey is you're like, wait, is this still the same state?
Yeah, that's
So,
right.
yep, I love it. That's awesome. And I was curious about those markets. I was like, well, those are 5, New York and New Jersey, I can understand, but all of a sudden you're like, yeah, then we're down in Florida. So that makes sense. You covered it where you worked, and so you're familiar with it. And also states where there is that asset class and that opportunity to serve that that demographic of people as well. They've certainly been pushed out of a lot of markets.
Sure. Absolutely.
So what are some of the, obviously a lot of things are changing economically in terms of, rents are going through the roof and different things like that. So what are some things that you guys do to, still be able to serve that and keep your margins and everything for your investors?
Yeah, I'd say we're in a pretty good spot in terms of our rent levels. We're still on the lower end of most of the comparables that are in the areas that we serve. So I'd say we're pretty competitive from that standpoint, and we are always, when we when we acquire a property, we come in right away and start implementing our capital improvement plan, which does take some time, but we just make sure we keep up with the maintenance and we keep up with tenant demands, and we're buying assets that have a very large loss to lease. So if we didn't do anything to the units, I'm sure we can get a pretty decent rent increase anyway, just like you mentioned, inflationary pressures. But we go in and we do work to get even more. And obviously that's the right thing to do as well. You don't just want to come in and raise rents for no reason. So we we're always underwriting pretty conservatively. What amount of capital do we think is necessary to put in to get X amount of rent increase, et cetera. So I think we're in a good spot. Obviously, the supply chain has been slower in terms of getting materials. So we've been, instead of replacing cabinets, we've been painting over cabinets. There's some other creative things we've been doing, holding more inventory for unit turns that come up, holding appliances. So it's, definitely interesting times. And, obviously real estate is, a benefit to inflation that is happening in the country. It's almost, I would say, it's a hedge against inflation. And obviously what you're saying, makes sense with asset values continuing to rise, particularly rents continuing to go up. I don't see that coming down anytime soon, although we're not going to have the 20-30% that we saw in the past 2 years. It's just not going to happen. It's not sustainable. So we are still going to see those pressures. And it's a good time to be an owner, but you still have to buy right. Obviously, with interest rates on the rise, you have to be smart about it. And some people who came into this business a year ago, 2 years ago, aren't used to seeing rates in the 5% range or even 6% range, and are going to have problems when they come to either refinance their loan or sell their property in terms of their investor expectations. I think there's going to be some pain ahead, which is a good opportunity for people who have been in the business for a while moving forward to capitalize on. So I still think there's a lot of runway and good things in the markets, that the demographic and the asset class that we're in.
Absolutely. Yeah. You nailed it on the head there. And something that I've been saying on a lot of my episodes about how, those operators that have set themselves up correctly are, poised to find some distressed assets, like you mentioned, because some of these operators who have been, so new to the game and have enjoyed low interest rates and kind of, you can kind of trip and fall and 2x your deal, just because purely the market is there. We'll certainly have to pivot and learn, a new business strategy, and business strategy in general is going to be even more important, because an acquisition is one thing, but then you have to implement the strategy and you have to do it correctly and effectively. And like you mentioned, with supply chain issues, that may mean holding inventory of some of your supplies and those things. So what are some other things, you've had to pivot and do along the way to kind of keep up with kind of the ever-changing landscape, especially as it pertains to materials?
Yeah, like I said, holding more inventory is definitely what we've done. We established partnerships with, it depends on who's doing the renovation work. We have maintenance technicians at each of our locations, and for the most part, they do the renovations. So it's in-house, so we have more control over material costs and, well, not really material costs, but we have more control over labor and how much we're paying our technicians. If we're paying overtime, that's cheaper than outsourcing it to a general contractor and having them put a margin on materials plus their labor. So we've been pivoting more to in-house, and I think that's a benefit of having the property management company. Even though it's a pain in the ass, it's still, it's, in our opinion, it's still worth it to have that. So, you could control some costs that way and control turnover, how to minimize turnover, and how to, if there is turnover, how quickly can we turn that unit and move on to the next tenant. So I think having the management company has been very helpful during these times. And, you're dealing with contractors that maybe have too much on their plate and don't even want to work still. Or they, they have too many jobs, other jobs that are more important, and it's hard to find a good contractor to, rely on. So we dealt with some of that. So that's why we pivoted to try to do it in-house. So that's what we've been doing to help mitigate the risk.
Awesome. I love that. And that was going to be my next question, was what was the idea behind bringing that in-house? You mentioned general contractors. Were you also not able to find good property management as well? You mentioned the contractors and not being able to find a good one, but was that also, the property managers weren't handling and managing the GCs well, or kind of talk about the thought process behind all of that?
Well, we started out managing our own properties, so we never really tried the third party management. I've been involved with third party management for the prior company I used to work for, and I've seen third party managers on other syndicated deals from other sponsors, and it's like night and day when you can control the management and you can control the construction somewhat. So we never really tried it, but from what I understand and based on our experience so far, it's been prudent to have it, as you mentioned, kind of have that infrastructure in place from the beginning. Whereas if you try to build a property management company now, it's going to be more challenging. So you just got to be prepared for world, or nationwide events like this. Obviously, no one knew the pandemic was coming, but you still gotta, the more you can control, the better it is, as long as you can support the infrastructure and the overhead. So as you start to scale, you're able to do more projects in-house.
Absolutely. I couldn't agree more. What are some, do you have any kind of tips for those who may be considering or even in the process of bringing in-house management, kind of getting started and kind of the keys?
Yeah, like I said, I would try to do a lot of work yourself. We self-managed without bringing on staff up until 120 units. So it was me and my partner. We didn't have anybody else. We didn't even have a super at our buildings. So we got to learn the hard way. That was really stupid, but we got to learn a lot, and we got to, we were fixing things ourselves. We got to learn a lot through that experience. So, and we understood some of the pricing for materials, and so we don't get ripped off when we, did start to not outsource, but maybe, sometimes outsource to different vendors for plumbing or electric repairs, etc. So, so I'd say get that experience managing, even if it's a single family home or a 2-family home first, and then kind of if you like doing it, then it's something you can expand upon. That's not for everybody. It's not the business that I enjoy, part of the business that I enjoy the most, but some people really like it.
Yeah, absolutely. There are definitely people who enjoy it, and it's their strong, kind of their superpower, so to speak. And, we're grateful for those people because it's very necessary in the business plan. So kind of talk about, you guys are, like you mentioned, in 5 different markets. What's it like having that in-house and having, kind of expanding to these different markets and having to build that team?
Yeah, as long as you have the infrastructure set up to grow, we have a workflow system, we have a communication system, we have maintenance technicians at each location, in each market. We have they're kind of roaming maintenance techs. Same thing with our leasing. We have roaming leasing agents as well. And as far as the rest of the structure for the management company, we have a bookkeeper who's kind of in-house as well, and virtual bookkeeper. And then we have a senior property manager who kind of oversees the management company at this point, oversees the maintenance techs, oversees the leasing, helps coordinate the move-ins and move-outs, helps with the collections at each property. So it's just a matter of getting your team in place, and you can apply it to different locations geographically as well once you have one set up.
Yeah, awesome. I love that. That's a really great perspective and insight there, because it's kind of a rinse and repeat, right? Once you have that in that framework, then you can just apply it, like you mentioned, to all the different markets. Awesome. Well, I love that. And I know, moving forward, that's, going to be important, like you mentioned, even more so because business strategy and implementation is really going to be what sets apart those who kind of make it through whatever's coming, and those who, may end up with some distressed assets in their portfolio. Awesome. Well, as we kind of wind down here, I've got 5 questions I ask all of my guests. It's the final 5, so we'll jump to those. First question: best advice you've gotten from a mentor?
Start slow. Don't go 100 miles a minute. Just start slow, and then progressively grow.
Awesome. I love that. What is it about your career that makes you feel like you're fulfilling your why?
As I mentioned before, I think it's pretty refreshing to really change communities around. We worked with town council and mayors and the kind of planning boards to achieve the same goal of kind of changing some communities around.
Awesome. I love that. Like I mentioned, kind of an underserved demographic. So that's great. You guys are doing that. Favorite non-real estate or investment related book?
Miracle Morning.
Nice. Great book. If you could have any superpower, what would it be?
If I could predict the markets, that would be great.
Gosh, that would be nice, right? They're like, man, he is crushing over there. What has he got going? He's always ahead. Yeah, just really great analytics.
Exactly.
Cool. Last one. What's the best way for people to get a hold of you and learn more?
Sure. We have on our website a quick ebook called How to Leave Your 9 to 5 Through Real Estate. And our website's redknightproperties.com, Red Knight with the K. So if you go on there, I'll send you that ebook, and then you'll get an email with the ebook. And on the bottom, it'll have all my contact information if you want to reach out, schedule a call. But you can still find me, Anthony Scandariato, on Facebook, Instagram, Twitter, LinkedIn, or our company, Red Knight Properties, also on all those platforms.
Awesome. I love it. We'll link the website in the show notes. Anthony, thank you so much for your time. I really appreciate it.
Thank you, Jonathan.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.